two different types of markets that we need to concern ourselves with. That is the spot market and the futures market. The futures market can also be known as the derivatives market. Futures and derivatives, they're going to be interchangeable for what we're talking about here today. So when it comes to the spot market, what we mean by spot is when you buy the actual cryptocurrency with dollars or with stablecoins or whatever it is, and you actually own the underlying token. Often, when you go into the market, you'll see that spot markets have something like BTC/USD. This is a spot market. That means that Bitcoin, which is the BTC, which is the numerator, is what you're buying with the denominator, USD. You're buying the BTC with the USD. It's the same for whether you have BTC and USDT, which is stablecoins. You're buying Bitcoin with USDT. You can change this to any number of spot markets and it all is the same. It depends on what type of stablecoin you're using. Everything is exactly the same. The next thing that we have is our futures markets or our derivatives markets. This is when you go into the market and you see something like BTC PERP, PERP. This is a perpetual futures market, or BTC with a bunch of numbers after it. This is a dated contract. So we have perpetual contracts and dated contracts in the futures market. The perpetual contracts operate in perpetuity, which means they last forever. The dated contracts are dated, which means that they expire on the given date. What you choose will be up to you. Dated contracts are a little more complex to understand for beginners, so we recommend that they stick with perpetual futures. Now, in the spot market, when you buy the actual token, you can do with that token whatever you like. You are now the owner of that token. So once you buy it, you can withdraw it from the exchange and you can take it somewhere else. You can stake it, you can move it around between accounts, you can do whatever you want with it. A futures market is a lot different because when you open up a futures position, that is an agreement between you and the exchange, and you can't take those cryptocurrencies or that position anywhere else. You don't actually own anything when you have a futures position. This is the biggest difference between the two. If you do not intend on moving your positions off the exchange, then it doesn't matter whether you choose spot or futures. For the most part, they're the same, other than the fact that perpetual futures, you need to pay a constant fee to keep that position open. For this reason, if you're going to be holding a position for a very long period of time, you choose spot. If you're hoping to open the position for a short period of time, often you'll choose futures. Also, when it comes to futures, you get to use leverage. So that is appealing for a lot of people. However, we warn you to stay away from leverage until you completely understand what it is and why you need to use leverage in what circumstances. This is an early lesson for everybody listening. If you use leverage, or if you feel like you know what leverage is, do not use it. You don't know what you're doing. It just serves to kill the most people in the market possible. The only reason why leverage exists is to maximize the fees from the exchange. It's not there to help you. Leverage is not there to help you. It's there to hurt you, okay? So don't use it. Don't use it until you're an absolute professional. At that point, you can do with it what you wish. If you're just starting out, don't touch it. So depending on whether you're using spot or futures, we also use different terminology to tell you what direction we're going in the market. If you open a spot position, which is buying the actual token that you own, we call that buying and then selling. So you buy when it's cheap and then you sell when it's more expensive and you take your profits out. However, when you move into the futures market, things are a little bit different. You go long and you go short. Long and short are not lengths of time or durations in the futures market. Long and short are directions. When we say we're longing something, that means that we're betting on the price to increase, just like buying. Buying and longing are interchangeable as terminology. Using futures, you can also bet on the decline of the market. So as it's coming back down again, you can profit from when the market starts to go down. This is called shorting. Shorting is where you sell at the top and then you buy back lower and you make a profit over that period of time. If you don't carefully use your words here, you can have miscommunications with people where you say that you're selling the top, and this could either mean that you have a spot position that you're converting from Bitcoin back into cash, for example, or it could mean that you're betting on the decline of the market. Implicitly, either one of these is true. However, the execution is different, which is the reason why instead of saying selling, we say shorting. And using buy or longing, they're the same thing, but selling and shorting are slightly different, which is the reason why a lot of confusion happens. So if you're in the spot market, you buy and sell. If you're in the futures market, you long and short. Before we wrap up, I want to reiterate the point between perpetual and dated contracts. So with perpetual futures, you have to pay a fee to the exchange in order to keep these positions open. This is called funding. It's like an interest rate that you have to pay to the exchange for the privilege of keeping this position open. Now, if you're using perpetual futures, this is true. However, if you're using dated futures, you do not have to pay funding because the contract expires after a certain period of time. The funding is priced into the actual value of that contract. This all sounds very complicated, but the fundamental point is that when you're using perpetual futures, you're constantly paying a fee, and when you're using dated futures, you do not pay constant funding fees on that position. What we've covered here is the difference between spot and futures, the difference between buying and selling, longing and shorting, and the difference between dated contracts with futures and perpetual contracts with futures. Now that you know the difference between all of these things, you should be able to use the right weapon for the right job when we're making either signal calls or when you need to make a position in your own portfolio. You'll be well informed. If any of these principles do not make sense to you, or you feel like you haven't grasped them fully, please rewatch the video so that your communication is at a high quality when you're in the market. Otherwise, you're going to be making small mistakes, and these can add up over time. So I'll see you in the next video.